talk about debt to income. I don't think people talk about debt to income enough. And you're like, why do I care? Well, because it's a great indicator, A, if you're going to get approved for a mortgage, and B, if you're going to be able to afford it when you do. So today I'm going to be talking to you about how a lender looks at your debt to income. And good news, Alyssa and Sandy have been very busy putting together a debt to income calculator that you guys can do either on the phone with them, just get on the calendar. It's always free. I would recommend doing it with them on the phone just because there's so many variables, and we'll talk about that today. But if you're like, nope, my situation's easy, email Sandy and I'll put her email in the description and she can get a copy of it over to you, okay? But I'll have the calendar in there too, and that is my suggestion. Okay, so debt to income. As a lender, I'm looking at two aspects of it. I'm looking at your front-end debt to income and your back-end. So the front end is your projected housing payment versus your gross income. So gross is before tax. Your back-end is your projected mortgage payment as well as the minimum monthly payments on your credit report. So your car loan, your credit cards, student loans. If you're in an income-based repayment program, we would be going off of that for some loans. Other loans have different parameters. So if you have student loans that are not reporting payments, I definitely think you need to talk to a lender when you're doing this because you're likely to calculate it incorrectly because there's so many variances based on loan program. I know, okay? So you're gonna, I would say like, look, go to Credit Karma. They're not charging right now to look at your credit. Look at your credit, look at your bills. Okay, do you have like a Macy's card? Maybe you owe $400 and the payment's $25. Great. That is what we're looking at when we're calculating that back-end debt to income. Now, there's one exception to that, and that is with VA loans, we also include child care expenses. That's the only loan that we do that on, and that's for daycare only, okay? So front end is the housing payment versus your gross income. Back end is housing payment plus the stuff on your credit report, maybe daycare if you're doing VA, and then versus your gross income. Now, people go, well, what is a good debt to income, Jen? It depends on your personal situation, but there's definitely some debt to incomes where I'm like, ooh, we need to have a talk. And if you do your debt to income calculation and it's 80% on the back and 30% on the front, you got a lot of debt. That's what's going on there. Because if your front end, the housing payment versus your gross is 30%, that means that other 50% that's getting you to 80%, it's what's on your credit report. That is not good, okay? That is signs that you need to start taking care of that, doing a budget and whacking away at debt. Now, something that's very important to note is that the way that lenders look at your income can be very different than the way you look at income. So let's start with income and how a lender looks at it. So if your commission, I'm gonna do a 2-year average. What that means is, let's say you made $100,000 in 2022 and $150,000 in 2023. Easy, I'm gonna add it up, divide it by 24, that is your monthly income. Now, if your income was $100,000 in 2022 and $50,000 in 2023, different story. You need to talk to a lender. Whenever your income's declining significantly, it could make it so you're just not eligible based off of that. Now, let's say it's $100,000 and it goes to 90. Okay, we're not gonna add the 2 years and divide by 24. We're just gonna do the 90 because it's declining. Okay, but a big decline, you need to talk to a lender because that can be a problem. Okay, commission, kind of tricky, not too much. If you have less than a 2-year commission history, you need to talk to a lender because for the majority of loan programs, we do require a 2-year commission history. Okay, but let's say you're like, Jen, I'm not even ready for a house. Okay, guys, then use what you think you're making, okay? And if you use what you think you're making and your debt to income is really high, once again, you got to get rid of some debt. Or you need a more realistic housing payment, okay? The easiest way to do a debt to income calculation is if you're salary, right? If you make, $60,000 a year, great, divide it by 12, that's going to be the income the lender uses, that's going to be the income you use. If you receive a bonus, we need a 2-year history. We're going to average it just like we did with the commission, okay? Hourly workers, if you work 40 hours a week, easy. If you get a ton of overtime, once again, you're gonna wanna do this with a lender. And look, if you are doing overtime, like Sandy and Alyssa can't even help you with that. I need an application, I need to do a written verification of employment. Like, I need a lot of details because you have to calculate that overtime over a 2-year period. And if it's declining, once again, you have a problem, so you have to look at the whole subset. Okay, to get accurate numbers. And I know I'm being annoying because I'm being so detailed, but it's because I see people do this stuff wrong all the time. And sometimes they disqualify themselves when they shouldn't. And other times they're so convinced that their debt to income is something different than what we're telling them. And it's because of the way a lender looks at income. And the way we look at it is not our personal feelings. It's based on the guidelines for generally Fannie, Freddie, or Ginnie. So really the easiest one to do is salary. Self-employed, you're like, oh, gross income, awesome. Not for self-employed. Self-employed, you definitely want to do an application with a lender and really look at it because we're going to be going off of your net as well as we have a few things we can add back in, okay? So if you're unsure how your income's going to be calculated, once again, get on the calendar, talk to the girls, they'll walk you through it. That's the first puzzle piece you need to know. Now the next is the mortgage payment. And I would advise for the first time you're doing this, think about what you're comfortable paying. So if you're comfortable paying $2,500, let's just write down $2,500 for the projected mortgage payment. Because when we get into the weeds of figuring out what your exact payment's gonna be, there's terrible calculators. Like, look, we have a calculator that we keep on working on and working on and working on at our company. I still don't think it's accurate enough that I would tell you guys to use that instead of talking to a lender when it gets to the nitty-gritty, okay? Because the nitty-gritty is gonna depend on the loan amount, the county you're looking in, what is the average property taxes, how do they calculate them? Homeowners insurance, what's realistic for the area, what's not? There's a lot of variables that can really sway your numbers. So I would say for when you're first doing this, do with what you're comfortable and let's look at your debt to income from there. Because a lot of times people will say to me, hey, I can totally afford $4,000. And I'm like, okay, but I do their debt to income and it's really high. And I'm like, actually, it makes more sense if you're at like 28, and we walk through that. So it can be a good way to gauge, are you assuming you can do too much? Or, sometimes I'll have people say, look, I can't afford a nickel over $2,500. And I look at their debt to income and we have a full conversation and I'm like, your debt to income's 25%. You can, but let's do a budget about what you're comfortable with, okay? And sometimes people just assume they have a really high debt to income when they don't. I'm one of those people. It doesn't matter how much money I will ever make, I will always feel like insecure about it, always. Some of us are just programmed like that. If you are, drop it in the comments so I'm not alone, but sometimes you're just always gonna feel like it's gonna be high even if it's nowhere near that. So this is a really good exercise to do that and a reality check. Okay, so you figured out your income. For the mortgage payment, you're gonna do what you feel comfortable with. Okay, great. So the easy calculation, it's basically just your mortgage payment divided by your income. Sometimes people go, okay, for front-end ratio, Jen, what should it be? There's no exact answer for what it should be. It really depends on your overall spending, because if I said, oh, it could be 30, 40%, but if you have a ton of debt, that's not gonna work. Or if I say, oh, it can't go over 30%, but you have no debt, that's not accurate either. So there is no one size fits all number. Really important you know that, because I know that Dave Ramsey pitches a one size fits all, but I'm telling you, there's not. Okay, so let's go to the second portion of the equation, which we talked about, which is the back-end ratio. And this would be easier if you had the calculator. I might have a link. I got to figure this out, okay? We may upload it to my website, and I'll have a link so you can do it. I'll put in the description what we decide to do. But I want you talking to the girls because I know it will be more accurate. Weigh in. Okay. Back-end ratio. So the back end, if I was doing this at home, what I would do is I would look at my credit report, you know, Credit Karma, some of the credit card companies show you, and I would write down, and I think this is a good thing to do anyways, because I think that when you write down what your debt is, it's more real. I know that sounds strange, but it's true. Try it. So write down, you know, Chase, $2,000. What's the minimum payment? Because that's what we're going to be calculating. So let's say the minimum payment's $100. Okay. And then you're like, car loan, $10,000, and the payment's $400. And that's all you have. Okay. So if you're doing your calculation, you're going to be doing the car loan plus that minimum payment. So we're at $500. Plus that mortgage payment divided by your gross income, and that will give you your back-end debt to income, okay? That was very simple because I just did two things, right? That's not normal for America. We're gonna have a lot more stuff on there. So you wanna make sure that you're writing down all the minimum payments. Now look, if it's a credit card you pay off every month, you don't have to put the minimum payment. Just make sure that when you're getting qualified, you tell the lender, hey, I pay off my XYZ every single month. American Express is a card I think about with that, because sometimes people put everything on it, and let's say they have a $2,000 balance. On an American Express, it's going to show that you have a $2,000 payment. Do not calculate that into your debt to income because you pay it off every month, okay? Student loans. Student loans, hopefully you have a payment. It's really easy if you do. Use the payment. If it's income-based repayment plan, we're going to go off of that for some loan programs, but some loan programs still have a calculation. If you're deferred and it's over 12 months and we can prove it, most loan programs will exclude it. If you're deferred but it's only for a couple months, you really need to talk to a lender because we need to talk about likely what type of loan you're going to do so we can help calculate that student loan payment for you accurately because it does vary. Okay, that's one of the trickiest things is the student loan payments if they're not already in repayment. Now, one more thing to know, if you're doing a VA loan, in addition to what's on your credit, we're also going to be including daycare. So if you have daycare expenses, you definitely want to put that, you know, for any loan. Okay, if you guys pay alimony or child support, that also goes into your debt to income. Even if you only have a couple months left, we have to hit you with it until it's 100% gone, okay? In terms of debt to income, one of the things that I think is really interesting, because after we fully underwrite people, I like to have a conversation with them, 20, 30 minutes, sometimes 40, sometimes an hour, because I like to see, you know, hey, we talk about debt to income on a lot of the calls, and I'll be like, you know, because sometimes I'll hear, Jen, I just can't afford this payment, and I'm like, your debt to income's 30%. What am I missing? Okay. And look, if it's a conventional FHA, USDA jumbo mortgage, it's probably daycare because we don't take that into consideration. The other thing that a lender's not going to take into consideration is tithing. It's not something that we look at. You know, we also don't look at if you're paying for your child's college, you know, unless it's on the credit report. So there's a lot of large expenses that you can have on a day-to-day basis that we don't ever see. So that's why it's really dangerous, you know, I would say, to ever assume that if a lender says that you qualify, you do. There's so much we don't look at. And with the calculator that Sandy and Alyssa built, it does have some of these additional items in there so that you guys, even though, look, the lender's going to have a lower debt to income than you, but if you're tithing or you have significant daycare, you're going to want to know what your debt to income is with those expenses because they will affect how happy you are in the house. When people's debt to income is pushing over 55%, it's really hard to get by. And if I have you, let's say we're doing FHA or VA, and I have you at 55%, and you have additional big expenses every month that we don't even know about, you're setting yourself up for a world of hurt. With conventional, often we can go up to 50%. Same thing, you know, so you really want to be cognizant of what is my debt to income, you know, and if you talk to your lender and you're like, hey, can we talk about my debt to income? And they say, why? You're with the wrong lender, okay? I bring it up on a lot of calls, not every call, and I need to remind myself to do that. Sometimes when it's really low, I don't go into it. If the debt to income's higher, I'm always going to go into it. And the reason is that, I was house poor once upon a time, and I know what that's like, and I've made it my mission that my clients never go into that with their eyes closed. If they're going to go into that situation, I'm going to make it real clear, hey, this is what I'm seeing, this is what I'd suggest. And sometimes I might see a higher debt to income, and my suggestion is this: do a budget, right? And honestly, seriously, guys, no matter where your debt to income is, a budget is a really good thing. So if you guys are like, oh God, a budget too, I don't know what to do. Alyssa, once again, Alyssa and Sandy, both of those gals are budget queens. And I've been talking to them a lot recently about, hey, how can we help people more? Because look, we're definitely, you need a loan. Okay, I can close your loan, no problem. I'll get you a great rate. We'll have a great time. It'll be wonderful. But sometimes people need a little bit more help, or they may be ready to get the house, but they just need a little bit more planning so that financially it's comfortable. So what we're gonna see in the new year, and you guys can ask for this whenever you want, with Sandy and Alyssa, just put in the notes on the calendar. I would love help creating a budget. They're happy to help. I would love to help with my debt to income. They're happy to do it. Okay, so definitely take advantage of all of these tools and the resources that I've put together for you guys, and basically having two amazing, licensed loan officer women who really care about financial health and who are happy to spend their time helping you with the stuff that none of us were taught in school. So as always, thanks for watching, and I will see you soon.